Yeah, dividends are a very interesting subject.
Imagine this. You wake up every morning to a bank account that's constantly replenished. Not by your 9 to 5 job, but by smart investments that pay you while you sleep. Sounds like a dream, right? But what if I told you it's entirely achievable, especially if you follow the wisdom of investment guru Charlie Munger?
You know, the game in our kind of life is being able to recognize a good idea when you rarely get it, and or when it rarely is presented to you. And I think that's something you have to prepare for over a long period. What is the old saying? That opportunity comes to the prepared mind. And I don't think you can teach people in 2 minutes how to have a prepared mind. But that's the game.
Did you know that, according to a report by Janice Henderson, global dividends hit a record high in 2021, reaching an astounding $1.47 trillion. This huge rise, up to 16.1% from the previous year, shows how stable and growth-friendly dividend-paying stocks are. It's a clear indication that, despite market uncertainties and economic challenges, companies across the globe are not only maintaining but also increasing their dividend payouts, presenting lucrative opportunities for investors focused on income generation. Today, we're diving deep into Charlie Munger's playbook to uncover the smartest and fastest way to build a life funded entirely by dividends. We're not just talking about scraping by. We're talking about a comfortable $5,700 per month. So, fasten your seatbelts and get ready for a Munger-style trip to financial freedom.
I want to report to all of you that in my whole life, I've never succeeded much in something I wasn't interested in. So I don't think you're going to succeed if what you're doing all day doesn't interest you.
Munger, renowned for his wisdom and partnership with Warren Buffett at Berkshire Hathaway, offers a unique perspective on dividends that goes beyond the conventional. His method isn't just about picking stocks with the highest yields. It's about understanding the underlying business, its long-term potential, and the role of dividends in wealth accumulation. Understanding Munger's philosophy. Munger's investment philosophy is deeply rooted in the principles of value investing, a concept pioneered by Benjamin Graham. He emphasizes investing in companies that are not only profitable, but also have strong fundamentals and a durable competitive advantage. Dividends as a sign of corporate health. In Munger's view, regular and increasing dividends are indicators of a company's stability and confidence in its future. He believes that a company that pays dividends is effectively saying, "We have enough confidence in our future cash flows to share profits with our shareholders." This is a sign of a mature, stable, and reliable business, the kind that Munger advocates investing in. The compounding effect. Charlie Munger's investment approach heavily emphasizes the power of compounding. He recognizes that reinvesting dividends can significantly accelerate wealth creation. This compounding effect is central to Munger's strategy. By reinvesting dividends, you're essentially buying more shares of the company, which in turn will generate more dividends, creating this virtuous cycle of growing wealth. Selecting the right dividend stocks. Munger's method involves meticulous selection of dividend-paying stocks. He advises investors to look for companies with a consistent track record of paying and increasing dividends. But it's not just about the dividend history. It's also about the business's quality. Munger prefers companies with a moat, a competitive advantage that allows them to fend off competition and maintain profitability. This could be in the form of brand strength, proprietary technology, market dominance, or regulatory barriers. Long-term perspective. Munger is known for his long-term investment horizon. He believes in holding stocks for an extended period, often several decades. This long-term perspective aligns perfectly with dividend investing, as it allows the power of compounding to work its magic. Munger often quotes, "The big money is not in buying and selling, but in the waiting." Remember, in the world of dividends, it's not just about the immediate yield. It's about the journey to financial freedom and the wisdom to choose the right path. Now, let's put Munger's wisdom into action. There are a few important steps that Munger takes to build a dividend portfolio. Number 1 being quality over quantity. Munger's investment strategy is grounded in the concept of concentrated investing. He believes in holding a small number of high-quality stocks rather than diversifying too broadly. The rationale is simple. Invest in a business you understand deeply and believe strongly in. Look for companies with strong competitive advantage, excellent management, and a proven track record of profitability. These companies are more likely to provide stable and growing dividends over time. Number 2, focus on management quality and corporate governance. A crucial aspect of Munger's investment philosophy is placing a high value on the quality of a company's management and its corporate governance. Munger believes that the caliber of people running a business is just as important as the business itself. Strong, ethical, and competent management is a key determinant of a company's long-term success, and by extension, its ability to pay consistent dividends. When assessing a company for investment, consider the track record and reputation of its leadership team. Look for management with a clear vision for the company's future, a history of making wise financial allocation decisions, and a shareholder-friendly approach. Good governance practices, such as fair treatment of shareholders, transparent communication, and responsible financial management, are also vital indicators of a company's health and potential for long-term growth. Investing in companies with strong leadership and governance structures provides a level of assurance that the business is in good hands. These companies are often more likely to navigate challenges effectively, sustain profitability, and continue rewarding shareholders with dividends. This approach aligns with Munger's emphasis on understanding not just what you invest in, but also who you are entrusting your money with. Number 3 is the strategic innovation and market adaptation. In alignment with Charlie Munger's insightful investment philosophy, it's crucial to focus on a company's ability for strategic innovation and market adaptation. This involves identifying businesses that are not just financially robust today, but are also poised to thrive in the future. Look for companies that are leaders in innovation within their industries, consistently investing in new technologies and adapting to market changes. These organizations are more likely to sustain growth, navigate economic shifts successfully, and continue delivering dividends. Their proactive approach to evolving with consumer trends, technological advancements, and global market dynamics is a significant indicator of their long-term viability and dividend-paying potential. By investing in such forward-thinking companies, you're adhering to Munger's principle of considering a business's future prospects as much as its present performance, ensuring a more resilient and growth-oriented dividend portfolio. Number 4, the role of valuation.
The concept of intrinsic value used to be a lot easier because there were all kinds of stocks that were selling for 50% or less of the amount at which you could have easily liquidated the whole corporation if you owned the whole corporation. Indeed, in the history of Berkshire Hathaway, we bought things at 20% of then liquidating value. And in the old days, the Ben Graham followers could run their Geiger counters over corporate America, and they could spill out a few things, and you could easily see, if you were at all familiar with the market prices of whole corporations, that you were buying at a huge discount. Well, no matter how bad the management, if you're buying at 50% of asset value or 30% or so on down, you have a lot going for you.
Valuation is a critical aspect of Munger's investment approach. Paying too much for a good business can still be a bad investment. Focus on buying stocks at a price that offers a margin of safety and aligns with the intrinsic value of the company. This approach reduces the risk of significant capital loss and enhances the potential for solid investment returns. Number 5, dealing with market cycles and volatility. Munger, known for his unshakable investment temperament, teaches us the value of seeing beyond the short-term market fluctuations. He understands that market volatility is not just an inevitable part of investing, but also an opportunity. A savvy investor should view the market downturns as opportunities to purchase quality stocks at lower prices, thereby increasing potential dividend yields. This approach requires a deep understanding of market cycles and the ability to remain calm and rational during periods of market turbulence. By adopting this mindset, you're not just passively waiting out the market's ups and downs. You're actively leveraging these cycles to strengthen your portfolio. This strategy aligns with Munger's philosophy of being fearful when others are greedy, and greedy when others are fearful, turning market volatility into a strategic advantage in your dividend investing journey. Number 6. Regular review and adaptation. While Munger advocates for a long-term approach, he also understands that businesses and markets evolve. Regular reviewing and, if necessary, rebalancing your portfolio is crucial. This doesn't mean reacting to short-term market fluctuations, but rather reassessing your investments in light of significant changes in business fundamentals or market conditions. By following these principles, you can create a portfolio that not only provides a steady stream of income, but also has the potential for significant capital appreciation over time. Achieving a monthly income of $5,700 from dividends is ambitious, but with the right strategy, it's attainable. Let's break it down. Number 1. Understanding yield and growth. To achieve $5,700 per month, you need to balance yield with growth. High-yield stocks might seem attractive, but they often come with higher risks and may not sustain your dividend payments. On the other hand, stocks with growing dividends might start with a lower yield but offer better long-term prospects. Munger's approach would favor companies with a moderate yield and potential for dividend growth, as this indicates financial stability and a commitment to shareholder returns. Number 2. Calculating the investment needed. Let's crunch some numbers. Assuming an average dividend yield of 4%, which is a realistic target for a well-balanced dividend portfolio, you would need a substantial investment to achieve a monthly income of $5,700. Our monthly income goal is $5,700, which puts our annual income goal at $68,400. So, our required portfolio size at 4% yield is $1,710,000. This calculation shows that to generate $5,700 per month at 4% yield, you would need to invest approximately $1.71 million. While this number may seem daunting, remember that this is a long-term goal, achievable through consistent investing and reinvestment of dividends. After calculating the substantial investment needed to achieve a monthly income of $5,700 with a 4% dividend yield, let's explore 3 alternative strategies beyond conventional stock investment. Number 1 strategy being real estate investment trusts, or REITs. REITs are companies that own, operate, or finance income-generating real estate across a range of property sectors. They offer a unique way to invest in real estate without having to buy property directly. REITs are known for paying out high dividends, as they are required to distribute at least 90% of their taxable income to shareholders. Investing in REITs can provide a diversified source of dividend income, often with higher yields than traditional stocks. Let's do the math to understand how investing in REITs could help you achieve a monthly income of $5,700. We'll assume an average dividend yield for REITs. While yields can vary widely, many REITs offer yields between 4% and 6%. For this calculation, let's use a conservative average yield of 5%. Your goal is to generate $5,700 per month in dividends. So number 1, our monthly income goal is still $5,700. Our annual income goal is still $68,400. And number 3, to find out how much we need to invest to achieve this annual income, we need to divide the annual income goal by the yield percentage. So, with an average dividend yield of 5% from REITs, you would need to invest approximately $1,368,000 to achieve your monthly income goal of $5,700. This calculation shows that REITs, with their higher average yield, could require a lower total investment compared to traditional stocks, which we previously calculated at 4% yield, requiring a $1.71 million investment. It's important to remember that while REITs can offer higher yields, they also come with their own set of risks and market dynamics, such as property market fluctuations and interest rate sensitivity. Diversification within your REIT investments across different types of real estate, like residential, commercial, healthcare, etc., can help lower some of these risks. Strategy number 2, Master Limited Partnerships, or MLPs. MLPs are partnerships that trade like a stock and are mostly involved in energy and natural resource sectors. They offer tax benefits and typically distribute a high level of their cash flow as dividends to investors. MLPs can be a lucrative source of income due to their high distribution yields. However, they come with different tax implications and risks related to the energy sector, which investors need to consider. Master limited partnerships, particularly those in the energy and natural resource sectors, often offer higher dividend yields, which can be an effective way to reach your dividend income goals more quickly. MLPs can have a wide range of yields, but they are often higher than traditional stocks and REITs. For this calculation, let's assume an average yield of 8%, which is within the typical range for MLPs. The target is to generate a monthly dividend income of $5,700. So first, our monthly income goal is $5,700. Our annual income goal is still $68,400. And to get our required investment for MLPs at an 8% yield, we have to divide the annual income goal by the yield percentage. With an average dividend yield of 8% from MLPs, you would need to invest approximately $855,000 to achieve your monthly income goal of $5,700. MLPs can offer a significantly higher yield, which means the total investment required to achieve the same monthly income is lower compared to traditional stocks and REITs. However, it's important to consider the unique risks associated with MLPs, such as their sensitivity to oil and gas prices, regulatory changes, and the specific tax implications of investing in MLPs. Diversification within MLPs and across other asset classes can help manage these risks while striving to achieve your income goals. Strategy number 3, dividend ETFs and mutual funds. Dividend-focused ETFs and mutual funds are a way to gain exposure to a diversified portfolio of dividend-paying stocks from a single investment. These funds are managed to maximize dividend income for investors. They offer diversification, reducing the risk associated with individual stocks, and are a convenient option for investors who prefer a more hands-off approach. Additionally, some dividend ETFs focus on high dividend yield stocks, or employ specific strategies like dividend growth or international dividend stocks, providing various options to align with your investment goals. These funds often target companies with strong dividend histories and potential for growth. Dividend ETFs and mutual funds can offer a range of yields. For this calculation, let's assume a moderate average yield of 4.5%, which is a realistic figure for many dividend-focused funds. The goal remains to generate a monthly dividend income of $5,700. So, number 1, our monthly goal is still $5,700. Our annual income goal is $68,400. And to find out our required investment for dividend ETFs or mutual funds at 4.5% yield, we have to calculate the necessary investment by dividing the annual income goal by that yield percentage. To achieve a monthly income of $5,700 with an average dividend yield of 4.5% from dividend ETFs and mutual funds, you would need to invest approximately $1,520,000. Dividend ETFs and mutual funds offer a slightly lower yield compared to REITs and MLPs, but they still require less investment than traditional stocks at a 4% yield. These funds provide the advantage of diversification, reducing the risk associated with individual stock investments. They are also a convenient option for investors looking for a more hands-off approach, as fund managers handle the stock selection and portfolio balancing. It is important to consider the expense ratios of these funds, as higher fees can impact the net yield and the overall return on investment. Each of these strategies offers a different approach to generating dividend income and can be used in conjunction with conventional stock investments to diversify your income sources and potentially enhance your overall investment returns. Finally, set realistic expectations. The path to achieving a significant dividend income is gradual and it requires time. Market conditions will fluctuate, and there will be periods of both growth and stagnation. Stay focused on your long-term goal and trust the process. In conclusion, navigating the path to a $5,700 monthly dividend income, whether it's through REITs, MLPs, or dividend ETFs and mutual funds, is a journey of careful planning and strategic investment. Each option offers unique benefits and varying levels of risk, aligning differently with individual financial goals and risk tolerances. Remember, achieving substantial dividend income is a long-term challenge, demanding patience, consistency, and adaptability. Consider your personal investment preferences and financial objectives as you choose your path. Which strategy resonates the most with you? Share your thoughts and join the conversation on building a robust dividend income portfolio.